Good morning, everyone. Today I'm going to share my report on financial decisions. Financial decisions refer to decisions concerning financial matters, which includes, of course, investment, allocation, and better utilization of financial resources of a business firm. With regard to financial decision analysis, which is a tool, is mainly used to assess the financial state of a company or organization. The financial decision analysis may either be internal or external. It is internal if the analysis originates from the company itself for its own purposes. The analysis is external if it is for the use of other entities outside the company. A financial decision analysis may also be further classified into two, vertical and horizontal analysis. A horizontal financial decision analysis is an internally generated process that involves the assessment of past financial transactions over a period of time. These include factors like balance sheets, profit and loss statements, income statements, cash flow analysis, and cash flow projections. Figures from the cash flow statements and income statements may be analyzed to give an accurate projection of the amount of sale a company needs to make before it can make enough money to settle its financial obligations toward its fixed and variable assets. The analysis helps a company project how much sales it will make to pay off its debts, its bills, and make money to cover the expenses for items like shipping and other services. A consistent result over several periods of study helps the company understand the financial trend of the organization. In the same manner, a vertical analysis is also a study of the financial trend in the company. The difference between the horizontal financial decision analysis and the vertical analysis is in the length of time. The vertical analysis is only based on the result of the financial statements of a selected period. A financial decision analysis may be done by people who are not related to a company. Such people may include potential investors, potential lenders, shareholders, suppliers, and government agencies like tax authorities. The purpose for such an analysis depends on the interest of the outside party. A potential investor may simply wish to find out the financial trends in the company with a view to finding out if it is a good investment. A lender may wish to find out the financial history of the company before deciding to lend money. Most of the external parties have to depend to a large extent on factors like published financial statements and other statements that the company may reveal. On the other hand, the internal analysis is done by the company itself with the benefit of all the records and other materials necessary to make an accurate financial decision analysis. In reference to many sources, there are three main types of financial decisions, and we have first investment, which is also called the capital budgeting. Second is financing, which is also called the capital structure. And third is dividend, which is also called the distribution of funds. Okay, let's take the first type of financial decision. We have investment or investment decision, which relates to the determination of total amount of assets to be held in the firm, the composition of these assets, and the business risk complexities of the firm as perceived by the investors. It is the most important financial decision since funds involved cost and are available in a limited quantity. Its proper utilization is very necessary to achieve the goal of wealth maximization. Buyers identify an investment as a purchased item or asset that would grow its value in the future and can be sold at a higher price. It can also be viewed as a property that enables its owners to generate passive income and create wealth over time. Investors have a lot of options for where to put their money. It is important to weigh these options carefully and fully understand the financial risk, because not all types of investment vehicles have the same reward and not all have the same levels of risk in investments. The investment decisions can be classified also under two broad groups. Okay, first is a long-term investment decision, and second is the short-term investment decision. The long-term investment decision is referred to as the capital budgeting, and the short-term investment decision as working capital management. Capital budgeting is the process of making investment decisions in capital expenditure. These are expenditures, the benefits of which are expected to be received over a long period of time, exceeding 1 year. The finance manager has to assess the profitability of various projects before committing the funds. The investment proposals should be evaluated in terms of expected profitability, costs involved, and the risk associated with the projects. The investment decision is important not only for the setting up of new units, but also for the expansion of present units, replacement of permanent assets, research and development project costs, and reallocation of funds in case investments made earlier do not fetch result as anticipated earlier. For an example of a long-term capital decision, this may be related to buying machinery for production, purchasing land, and building for expansion. Meanwhile, for short-term capital decisions, this may be related to buying the inventory or stocks, expenses for day-to-day activities. Short-term investment and long-term investment may vary in terms of the following elements. First, we have time period. Second, market risk. Third, liquidity. Fourth, loss coverage. Fifth, rate of returns. And sixth, investors. As the name suggests, short-term investments are held for a short duration of time, generally less than a year. Investors may sell or exit or liquidate their investment in such assets even in a few hours, such as in the case of intraday trades. In other instances, they may hold their investments for a few weeks or days even or months and then sell them. On the other hand, long-term investments are held for a longer duration of time, always more than a year. Investors may hold such investment for time periods as long as 20 years or even more in some cases, such as government bonds. Investors hold assets such as real estate and stocks too for many years before actually selling them. Second is market risk. The level of risk is low to moderate in the case of short-term investments. This is because the time span is quite less for factors such as changes in interest rates to affect the prices of such investment. Or for that matter, any major political or economic event can affect the value of such investments. This short frame urges the investors to invest in relatively safer options that will give them moderate returns along with the safety of their investments. However, there are exceptions to this rule, like intraday traders who indulge in high-risk trading activities regularly. Whereas, except in cases of government bonds, long-term investments always carry an element of high risk. Their prices and returns can be volatile. In some cases, they may provide negative returns even after holding them for several years. The time span is very long, which gives ample time for any adverse changes in the market factors such as interest rates, rules and regulations of the government, company performance, financial strength of the company, economic scenarios, project and product viability, competition, and others to affect the prices of such investments. Okay, third is liquidity. Short-term investments have a high degree of liquidity. Investors can convert them into cash or equivalent at very short notice. For example, we can easily sell short-term investments like shares and convert them into cash within a day. However, long-term investments are usually illiquid in nature. It is usually not possible to convert them into cash or equivalent at a very short notice. Investors will take a considerable number of days to sell long-term investments like real estate and get money in return. Fourth is covering of losses. Short-term investments do not provide enough time for investors to cover their losses in case their investments turn negative. Therefore, short-term investors have to suffer a loss whenever these investments see a decrease in value. And in case the investor has to liquidate their position and exit, long-term investments provide opportunities for investors to wait for the correct time to sell their investments and make profits. Even if an investment offers negative returns over a small period of time, the investor can wait and keep holding it. The temporary low may be due to business cycles, recessionary phase, or simply due to temporary poor performance of a company or sector. Investors can sell their investments whenever the investment rebounds and prices go up. And then fifth is the rate of returns. Short-term investments usually provide lower rates of return than long-term investments. For example, short-term bonds offer a lower rate of interest than long-term bonds. Also, it is a proven fact that long-term investments provide ample opportunities for true capital appreciation, unlike short-term investments. As these are for short maturities and carry a lesser risk, the returns are also low in these investments. Some long-term investment assets like real estate and shares grow in value manifold when held for several years. Also, the element of long-term provides an investor with an opportunity to perfectly time his exit from the investment and make maximum profits out of it. And lastly, number six is active and passive investor or investors. Active investors usually invest in short-term investments since they are dedicated and can give sufficient time to take care of their investments. Passive investors usually prefer to invest in long-term investment avenues and hold them for a long duration of time. It is difficult for them to track their investments daily or very frequently, and hence they prefer the passive approach. The uses or common uses of short-term investments can be to arrange funds for office renovation and improvement, making a purchase for office or just for saving purposes. Investors use long-term investment options to prepare a corpus for their retirement or such major future expenditures, or simply build wealth when they have surplus funds with them. In general, there are four different types of investments. This includes stocks, bonds, funds, and cash equivalents. And within these categories are also subtypes of investment classes. Okay, let's take the first type of investment. Okay, we have the stocks. Stocks are ownership shares in a corporation, and they are classified as common, preferred, blue chip stocks, and others. When you buy stocks, you are essentially buying a piece or unit of ownership in a company called shares. And this means that if you own or invest in stocks or a company, you become one of its owners or shareholders. Thus, you share in the company's profits, and companies sell their stock through a stock exchange. Investors purchase shares that increase in value as the company grows. Investors can sell them or can sell these shares down the road and make a profit. And stocks can appreciate or depreciate in value, so they carry some inherent risks. Stocks can generate money in two major ways. And first is buying some shares and selling them when they increase in price nets to profit from capital gains. Second is through dividends. Companies regularly pay out part of their profits to shareholders in the form of quarterly dividend payments. However, not all stocks pay dividends. Historically, the stock market has an average return of 10%, and this figure is an average for the entire market, not individual stock. The average return for any given year can be more than or less than 10%. Okay, there are two different types of stocks, and each of with different types of investment risk. Okay, first is a common stock. Common stock is the most common kind of stock in the type that is traded the most. Okay, buying common stock represents a claim of ownership in a company and provides voting rights. Investors get one vote per share and can vote on the board members who oversee management. Common stock has the most potential for gain out of the traditional investment classes. Number two is the preferred stock. Okay, preferred stock does not confer voting rights, but preferred stockholders are entitled to priority for dividend payments. Preferred stock normally has a static dividend yield, whereas with common stock, dividend payouts can vary based on the board of directors. Many companies allow shareholders to convert preferred shares into common stock, but not vice versa. When we say stock market, this is a place where stocks are traded, okay, both and sold. And the Philippine Stock Exchange, or PSE, is the national and only stock exchange of the Philippines. The Philippines Stock Exchange Composite Index, or PSEI, is a fixed basket of 30 common stocks of publicly listed companies carefully selected by the exchange to represent the general movement of the Philippine stock market. And as of February 2019, okay, these are the stocks in the composite index. It includes Ayala Corporation, Aboitiz Equity Ventures Incorporated, Alliance Global Group Incorporated, Ayala Land Incorporated, Aboitiz Power Corporation, BDO Unibank Incorporated, Bank of the Philippine Islands, DMCI Holdings Incorporated, Energy Development Corporation, First Gen Corporation, Globe Telecom Incorporated, GT Capital Holdings Incorporated, International Container Terminal Services Incorporated, Jollibee Foods Corporation, JG Summit Holdings Incorporated, LT Group Incorporated, Metropolitan Bank and Trust Company, Mega World Corporation, Manila Electric Company, Metro Pacific Investments Corporation, Petron Corporation, Pure Gold Price Club Incorporated, Robinsons Land Corporation, Semirara Mining and Power Corporation, Security Bank Corporation, San Miguel Corporation, SM Investments Corporation, SM Prime Holdings Incorporated, PLDT Incorporated, and Universal Robina Corporation. In the market, trading of stocks is based on board lot, the minimum number of shares one can trade at a specific price range. However, there is also an odd lot system for other number of shares less than the minimum required. Stock prices move through a scale of set price fluctuations. Basically, we have the law of supply and demand, and the many factors influence fluctuations. Shareholders participate in the growth of the corporations and earn revenues through price appreciation, which means the increase in stock price over time, and dividends, such as which means the cash or additional shares of as part of the profit. Stock investors and traders play different roles in the market. Generally, stock investors practice the buy and hold strategy, hence buying and holding onto stocks for quite a long term, while stock traders usually try to profit from short-term price volatility and actively trade from a few seconds to a couple of weeks. To enter the market, investors and traders need a stockbroker who is a professional individual or a firm that executes buy and sell stock orders for a fee or commission. Investors and traders place orders online through scriptless trading. Hence, online brokers do not issue stock certificates unless requested. Peso cost averaging is a time-tested stock investment strategy of investing a fixed amount of money at regular intervals to minimize risk in a volatile market. If the stockbroker goes bankrupt, you need not to worry much because the Philippine Stock Exchange and Securities and Exchange Commission have established protection measures for stock investors and thus will arrange the transfer of your assets to another stockbroker or the one you prefer. If the corporation you invested in goes bankrupt, it is obliged to liquidate all assets and pay off all debts. Usual order of debt payment starts with the government, financial institutions, creditors, bondholders, preferred shareholders, and lastly, common shareholders. In doing your stock investment homework, start with the difference between the two primary schools of thought. We have the technical and fundamental analysis. When we say technical analysis, this is an evaluation of stock movement based on market factors and data including trading volumes, historical stock price fluctuations, and industry trading trends, hence predicting future stock price movement. Meanwhile, for fundamental analysis, this involves calculation of the intrinsic value of a stock based on economic factors such as income and expenses, growth, competitions, and returns on equities. The second type of investment is bonds, which are a fixed income investment between an investor and a borrower. Okay, bonds are essentially a loan that an investor or debt holders or creditors issue to some entity, such as corporate or government, with the promises of the borrower to repay the interest of the borrowed money at a predetermined or fixed date, usually annual or semi-annual, okay, through IOU, and will need to return the principal on agreed upon maturity date. Okay, bonds are used as a way to secure capital to finance projects, especially that most corporations and governmental entities can rely on bonds to fund projects because they often need much more money than they could secure from a traditional bank loan. Okay, bonds refer to debt instruments with maturities of 10 years or more, and most people, however, use the term bonds loosely to refer to almost any debt instrument regardless of maturity. Okay, there are two types of bonds. Okay, first is by maturity period. A fixed income instrument that matures in 1 year or less is called a bill. A popular example is the short-term debt obligation of governments, usually called treasury bill or T-bills, while a debt obligation that matures between 2 and 10 years is called a note. An example is the government's treasury note or T-notes. And as explained earlier, a fixed income instrument that matures in 10 years or more is called a bond. The second type of bond is by the issuer. A fixed income instrument issued by the national government through its Treasury Department is called the Treasury Securities. Depending on the maturity of period, this may be Treasury bills or T-bills, Treasury notes or T-notes, or the Treasury bonds or T-bonds. Government agencies can also issue bonds to raise funds. For example, um, in the U.S., okay, these may include Government National Mortgage Association, Government-Sponsored Enterprises Federal National Mortgage Association, and Federal Home Loan Bank Corporation. And we also have the Student Loan Marketing Association. Meanwhile, in the Philippines, Pag-ibig or the Home Development Mutual Fund also issues bonds to raise needed capital. Okay, local government units sometimes also use that instrument to acquire funds. Municipal bonds backed by the full taxing power of the municipality is called a general obligation bond. Okay, bonds issued by the municipality to finance a government project whose interest and principal payments are dependent on the income of that project are called revenue bonds. In the Philippines, examples of municipal bonds are the Puerto Rico Princesa Green Bonds, Boracay Aklan Provincial Bonds, and Tagaytay City Tourism Bonds. And lastly, a bond issued by a business entity is called a corporate bond. Corporations use bonds as an alternative to stocks in raising capital. Examples of companies in the Philippines regularly issuing corporate bonds include Ayala Corporation, Globe Telecom, JG Summit Corporation, Philinvest Land, and others. By interest coupon structure, a bond investor earns from the regular coupon interest payment. However, not all bonds pay regular interest though. A bond that does not pay any interest rate is called a zero coupon bond. And since investors don't receive interest payments, the only way for them to earn is to buy these bonds at huge discounts so they can profit afterwards when the bonds are redeemed at their par value. Okay, bonds with a stated interest rate but are not paid until maturity are called accrual bonds. Investors don't receive interest prior to maturity, but they accrue and compound and are paid during the maturity period. A bond that pays an initial interest rate for the first period, then a higher rate after the period is called a step-up bond. For example, a 10-year maturity bond may offer 5% fixed interest for the first 4 years, then starting on the 5th year, the interest rate is 7%. Floating rate bonds are bonds whose coupon rate is linked to a benchmark rate. This benchmark rate may be the country's inflation rate, the London Interbank Offered Rate, or other rates. A floating bond rate, for example, that pays a coupon rate equal to 2% plus the inflation rate will pay 5% if the inflation rate is 3%. If the interest rate is 5%, then the bond will pay 7%. The third type of investment is investment fund. Investment funds come or are sourced from different investors, and a mutual fund is one of the most common types of investment fund. Mutual funds are a third category of investment vehicles. Mutual funds pool money from multiple investors to buy a wide range of assets, including stocks, bonds, and other assets. You can think of mutual funds as collective investments. A large group of people all invest their money in a pool of securities and get a piece proportional to how much they put in. Mutual funds cover a wide range of investment securities, and people share proportionally in the losses and gains of the fund. Whether or not a mutual fund does all will depends on the performance and risk of the securities it is invested in. Mutual funds are different from stocks and bonds because, unlike stocks, they do not give owners voting rights, and unlike bonds, returns track market performance instead of interest rates. The value of a mutual fund is called the net asset value per share and is calculated by dividing the value of the portfolio by the total number of shares in the fund. Another way you can think of mutual funds is investing in a company that invests in securities. Individuals investors own portions of the shares of the funds through their investments in the company that manages the funds. This dual-tiered structure makes mutual funds a very flexible type of investment vehicle that manages risk well. The risk of particular mutual fund depends primarily on the different types of securities the fund is invested in. Funds that invest primarily in stock, therefore, have a higher risk than funds that equally allocate money between stocks, bonds, and other low-risk fixed income assets, for example. Mutual funds are also subject to all the risk that specific security types are subject to. With mutual funds, risk and returns generally share an inverse relationship. You can gauge the risk level of a fund by looking at how its returns have changed year to year. If, if it fluctuates a lot, then that could be an indicator that it is a high-risk fund. There are several types of mutual funds, but two are the most common. First, we have the index funds, which are mutual funds that track some specific segment of the market. For example, many index funds track the indices of large stock exchanges. Index funds are a type of passive investment and only track certain market indexes. As such, they have a low risk. They do not try to beat the market and they are only priced at the end of each trading day. Second is the exchange-traded funds, which are similar to index funds but with one major difference. ETFs can be traded throughout the day, just like a regular stock. ETFs also tend to have lower taxation and management fees than index funds but have more risks. There are top seven mutual fund companies in the Philippines, and this includes the Philippine American Life and General Insurance Company, or Philam Life, which is the largest life insurance company in the Philippines and the market leader for over 65 years. Philam Life offers an extensive line of products in the industry that provide solutions to various financial needs, including life protection, health insurance, savings, education, retirement, investment, group and credit life insurance. And Philam Life has the most extensive network of offices and sales agencies nationwide. We also have Sun Life, which is a leading global financial services company based out of Canada. Sun Life introduced life insurance in the Philippines in 1895 and are proud to be country's first and longest standing life insurer. We also have the First Metro Investment Corporation, or FMIC, which is this investment banking arm of the Metro Bank Group and one of the largest financial conglomerates in the country. FMIC has over 50 years of experience in developing the country's capital markets. We also have Coco Life, the biggest Filipino-owned stock life insurance company and the first and only ISO certified Filipino life insurance company, is a prominent market leader in the industry. Coco Life offers a complete array of life insurance, non-life insurance, healthcare, and mutual fund products through its various business units and subsidiaries in the non-life business, pre-need, and mutual funds. Another one is the Great Pacific Life Insurance Corporation, which is the life insurance flagship of the Yuchengco Group of Companies, or YGC, and one of the Southeast Asia's largest conglomerates. It is consistently one of the top ranking industry players and the leading company in group insurance in the Philippines today. Grepa Life continues to provide world-class financial products, services, and benefits that are affordable yet value-laden. Another is the ATR Asset Management Group, or ATRAM, which operates through ATR Asset Management Incorporated and the ATRAM Trust Corporation. ATRAM is the leading independent asset manager in the Philippines with over 1.9 billion US dollars in assets under management, providing investment management solutions to retail and institutional clients. Another one is the Phil Equity Management Incorporated, which is an investment management and mutual fund company in the Philippines that was established in 1993. PEMI is committed to helping their clients achieve their long-term financial objectives by offering an array of mutual funds suited to their needs. Okay, still relative to investment, others may opt to invest in a college fund, which includes Sun Life, Sun Smarter Life Elite, Sun Accelerate, Sun MaxiLink Prime, Sun MaxiLink Bright, Sun FlexiLink, AXA, Academics, Academic Essentials, BDO Life, Manulife, Education Builder, Insular Life, Wealth Assure Education, Wealth Secure Education, and of course the PruLife UK. And still on mutual fund, and others may also opt to invest for a retirement fund, okay, which come in handy as a way to have continuous cash flow. Okay, while still able, workers can save money and receive pension upon retirement. We have first the pension plans. Okay, pension plans provide clients with monthly allowances or whole lump sum amounting to their total contributions. One of the most accessible pension plans in the Philippines is facilitated by Social Security System, or SSS, and this is considered as one of the easiest ways to invest since SSS contributions are mandated by law and are automatically deducted from the employee's salary. Other constitutions like banks and insurance companies also offer a variety of pension or retirement plans. Number two, we also have the PERA, okay, which stands for Personal Equity and Retirement Account. The Personal Equity Retirement Account, or PERA, has been fully implemented by law in 2016. This is Republic Act number 9505, an act establishing a provident personal savings plan known as the Personal Equity and Retirement Account, or PERA. According to financial analysts, this is the Filipino counterpart of the 401,000 contribution plan, or the Individual Retirement Account, or IRA, in the United States. PERA is a type of retirement investment plan that can only be availed through banks, insurance companies, or any other administrator accredited by the Bangko Sentral ng Pilipinas, or BSP, the Insurance Commission, and the Securities and Exchange Commission. PERA is a voluntary retirement contribution plan that gives the employee the freedom to save and invest up to 100,000 annually. Also, the returns are completely tax-free. We also have PERAA, okay, which stands for Private Education Retirement Annuity Association. Okay, this is to provide adequate and affordable retirement programs Two, participating private educational institutions through the achievement of economies of scale from commonly managed funding and retirement arrangements, and by operating as a non-profit organization administered by a highly motivated and competent board of trustees. We also have insurance plans. Okay, another way to invest for your retirement is through insurance plans wherein contributions can result to lump sum later in life. Aside from the financial protection, it can provide you and your family upon your death and in the event of critical illness or accident. It is also an investment which you can potentially grow. FWD Insurance, for instance, has bundled plans that will address all these needs. Okay, like life protection, investment, critical illness and accident, and so on. We also have financial funds. Okay, banks, insurance companies, and other institutions offer a variety of funds already invested in a diverse set of industries. Bonds, stocks, and other investments can be quite complicated, but these institutions have fund managers who will take care of it for you. Some insurance companies like FWD even offer funds with returns in US dollars for more profit. And lastly, we have the real estate. Okay, owning a home or any property by the time you turn 50 or 60 is one of the main goals of Filipinos, and for good reason. It's an investment that makes sense, especially if you can no longer rely on a monthly income for rent. The value of your house or condominium unit appreciates as the years go by, especially if you have chosen a good location. In addition, owning property that can eventually be rented out can give you a source of income once you also have retired. Fourth type of investment is cash equivalent. Cash equivalents are the third of the major types of investment and the least widespread. Cash equivalent are low-risk securities that are highly liquid and meant for short-term investing. Common cash equivalent investments include bank CDs, corporate commercial papers, and money market instruments. Basically, cash equivalents are assets that are either cash themselves or can be converted to cash immediately. Cash equivalents tend to be the most stable kinds of investments because the underlying investment asset is cash, which does not fluctuate in value as stocks or bonds do. Companies that have lots of cash on reserve have a high ability to pay off short-term debts and liabilities. Other kinds of investment assets that have a maturation date of fewer than 3 months are often considered cash equivalent investments. So what is the difference between cash and cash equivalents? Cash is ownership of actual, okay, United States dollars or other currencies like peso, while cash equivalents are financial vehicles and investments that are incredibly easy to convert to cash. Cash equivalents are not the same as cash, though they have such low risk and high liquidity that the company can easily sell its cash equivalents, often not having to worry about losses for actual money. There are types of cash equivalents. This includes treasury bills, which are commonly referred to as T-bills. When issued to companies, companies essentially lend the government money. We also have commercial papers, which are used by big companies to receive funds to answer short-term debt obligations, like a corporation's payroll. They are supported by issuing banks or companies that promise to fulfill and pay the face amount of the designated maturity date provided on the note. We also have marketable securities, which are financial assets and instruments that can easily be converted into cash and are therefore very liquid. Marketable securities are liquid because maturities tend to happen within 1 year or less, and the rates at which these may be traded have minimal effect on prices. Another one is the money market funds. Money market funds are like checking accounts that pay higher interest rates provided by deposited money. Money market funds provide an efficient and effective tool for companies and organizations to manage their money since they tend to be more stable compared to other types of funds like mutual funds. Another is the short-term government bonds. Short-term government bonds are provided by governments to fund government projects, and these are issued using the country's domestic currency. Investors take a look at political risk, interest rate risk, and inflation when investing in government bonds. We also have the Certificate of Deposits or the CDs. Certificate of Deposits are agreements with a financial institution to provide the bank access to your capital for a specific period. In return for sacrificing liquidity over your money, the financial institution will often pay a higher amount of interest for the capital. Savers can choose their CDs term, often ranging from 1 month to 5 years. Another one, and the last, we have the bankers' acceptances. Bankers' acceptances are forms of payments that are guaranteed by a bank rather than an individual account holder. Because the bank guarantees payments, the short-term issuance by a bank is considered close enough to cash. Bankers' acceptances are frequently used in facilitating transactions where there is little risk in their party. Now, what are the uses of cash equivalents? Okay, there are several reasons a company might store their capital in cash equivalents. First, cash equivalents are part of the company's net working capital, or the current assets minus the current liabilities, which it uses to buy inventory, cover operating expenses, and make other purchases. Because cash equivalents are so each to buy and sell, a company may carry its cash balance in near cash investments. Second is cash equivalents can also act as an emergency fund for companies or investors. Again, instead of watching cash decay due to inflation in a bank account, an investor may be able to earn slightly more earnings. Lastly, companies may intentionally carry higher balances of cash equivalents in the event of needing to finance an acquisition. Instead of locking capital into a long-term or volatile investment, a company can choose to deliberately sit on a pile of cash equivalents in the event it needs to quickly raise funds. Now, how are cash equivalents used? If a company has excess cash on hand, it may invest capital in a money market fund. This fund is a collection of short-term investments. Example, generally with maturity terms 6 months or less, that earns a higher yield than the cash would just sitting in a bank account. When the company decides it needs the cash, it sells a portion of its money market fund holdings and transfers the proceeds to its operating account. Now, why are cash equivalents important? Cash equivalents strive to be the balance between investing, risk, and liquidity. Cash equivalents allow a company to have easy access to cash should it need to immediately sell its cash equivalents. In addition, cash equivalents allow companies to earn a little bit of interest as it plans how it will use its liquidity in the long term. The second type of financial decision is financing decisions or capital structure decisions. Once the firm has taken the investment decision and committed itself to new investment, it must decide the best means of financing these commitments. Since firms regularly make new investments, the needs for financing and financial decisions are ongoing. Hence, a firm will be continuously planning for new financial needs. The financing decision is not only concerned with how best to finance new assets, but also concerned with the best overall mix of financing for the firm. First, a finance manager has to select such sources of funds which will make optimum capital structure. The important thing to be decided here is the proportion of various sources in the overall capital mix of the firm. Secondly, it is concerned with borrowing and allocating the funds for the investment. Finance can be raised from the owner's fund and borrowed funds. If the companies are having a smooth cash flow, then borrowed funds are preferable. Owners' funds include share capital and retained earnings, whereas debentures, loans, bonds are included in borrowed funds. Under this, the finance manager has to focus on the advantages and disadvantages of both sources. The debt equity ratio should be fixed in such a way that it helps in maximizing the profitability of the concern, and the raising of more debts will involve fixed interest liability and dependence upon outsiders. It may help in increasing the return on equity, but it will also enhance the risk. And the raising of funds through equity will bring permanent funds to the business, but the shareholders will expect higher rates of earnings. The financial manager has to strike a balance between unused sources so that the overall profitability of the concern improves. If the capital structure is able to minimize the risk and raise the profitability, then the market prices of the shares will go up, maximizing the wealth of shareholders. Now, here are some factors affecting financing decision. Okay, first is cost. The cost of raising funds from different sources is different, and the cost of equity is more than the cost of debts. The cheapest source should be selected prudently. Risk is associated with different sources is also different. More risk is associated with borrowed funds as compared to owner's fund, as interest is paid on it and it is also paid or repaid after a fixed period of time or on expiry of its tenure. Okay, third is flotation cost. The costs involved in issuing securities such as broker's commission, underwriter's fees, expenses on prospectus, and others is also called flotation cost. Higher the flotation cost, less attractive is the source of finance. Okay, fourth is the cash flow position of the business. In case the cash flow position of a company is good enough, then it can easily use borrowed funds. The fifth is control considerations. In case the existing shareholders want to retain the complete control of business, then finance can be raised through borrowed funds, but when they are ready for dilution of control over business, equity shares can be used for raising finance. Number six is the state of capital markets. During boom period, finance can easily be raised by issuing shares, but during depression period, rising or raising finance by means of debt is easy. The dividend decision is the third major financial decision which relates to the disbursement of profits or dividend back to investors, creditors, debenture holders, shareholders, and others who supplied capital to the firm. It is the reward of shareholders for investments made by them in the share capital of the company. Okay, the dividend decision is concerned with the quantum of profits to be distributed among shareholders, and the decision has to be taken whether all the profits are to be distributed, to retain all the profits in business, or to keep a part of profits in the business and distribute others among shareholders. The higher rate of dividend may raise the market price of shares and thus maximize the wealth of shareholders. The firm should also consider the question of dividend stability, stock dividend or bonus shares, and cash dividend. The financial manager decides about the stable dividend policy. The goal of the policy is a balanced and foreseeable dividend payout each year, which is what most investors seek. The constant dividend policy is when a company pays a percentage of its earnings as dividends every year, and residual dividend policy is when a company will prioritize capital expenditures before paying out dividends to its shareholders. Now, here are factors affecting dividend decision. First is earnings. Company having high and stable earning could declare high rate of dividends as dividends are paid out of current and past earnings. Number two, stability of dividends. Companies generally follow the policy of stable dividend. The dividend per share is not altered in case earning changes by small proportion or increase in earnings is temporary in nature. Okay, third, we have growth prospects or opportunities. In case there are growth prospects for the company in the near future, then it will retain its earnings and thus no or less dividend will be declared. Okay, fourth is the cash flow positions. Dividends involve an outflow of cash and thus availability of adequate cash is foremost requirement for declaration of dividends. Fifth, the preference of shareholders. While deciding about dividend, the preference of shareholders is also taken into account. In case shareholders desire for dividend, then company may go for declaring the same. In such case, the amount of dividend depends upon the degree of expectations of shareholders. Sixth is the taxation policy. A company is required to pay tax on dividend declared by it. If tax on dividend is higher, company will prefer to pay less by way of dividends, whereas if tax rates are lower, then more dividends can be declared by the company. Number seven is the stock market reactions. The share price is directly related to the rate of dividend declared by the company. Share prices of a company increase if the company declares higher rate of dividend. Therefore, the financial management considers the potential effect of dividends on the share prices before declaring dividends. Number eight is access to capital markets. Decision regarding amount of dividend to be declared depends on the need of profits to be retained for future investments. Companies who have easy access to the capital market to raise funds may not require large amount of profits to be retained and therefore may decide to declare high dividend rate. On the other hand, small companies who find it difficult to raise funds from capital markets may decide to share lesser profits for their shareholders. Number nine is legal constraint. Every company is required to adhere to the restrictions of provisions laid by the Companies Act regarding dividend payouts. And lastly, number 10, contractual constraints. Sometimes, companies are required to enter into contractual agreements with their lenders with respect to the payment of dividends in the future. The dividend decisions need to consider such restrictions while declaring dividend rate to ensure that terms of loan agreement are not violated. And that ends my presentation on the types of financial decision, and I hope I was able to impart something through this presentation. Thank you for listening and have a nice day, everyone.